On to this session on money. We've had a bit of a change in personnel. Unfortunately, Len Seabrook, for family reasons, had to drop out, for which he sends his apologies. So we've had a bit of a reconfiguration. I've come in to chair it, clearly, and Manuel Albers has kindly taken Len's place as a speaker. Now, this session on money perhaps follows in a long tradition of such sessions at ENHR conferences, as we've addressed questions of booms and busts in housing markets. Invariably, these sessions have been approached from a single disciplinary perspective, from that of economics. And today we wanted to do something a bit different in two respects. First, we want to explore explicitly the relationship between money or finance and housing, and indeed to consider its role in housing market instability. But we also wanted to explore the way in which money or finance, the so-called financialization of housing, has changed its nature, moving away from merely being a source of shelter and home to a wider welfare function. And indeed, one of the arguments that was made towards the end of the last boom was that asset price accumulation was being used as a way to compensate for those people who were losing out as income inequality grew. So to discuss these issues, we're very lucky to have two great speakers today. We have David Miles, who is a professor at Imperial College, and since 2009 has been a member of the Bank of England's Monetary Policy Committee. Now, just for the avoidance of doubt, the Bank of England was obviously founded by a Scot. And equally, obviously, its Monetary Policy Committee is responsible for monetary policy throughout the whole of the United Kingdom. So now we've cleared that up. I'd also like to say that David has made a remarkable contribution to the debates on housing and the economy over many years. He wrote a very influential book in the 1990s. A decade ago, he was appointed by the UK government to conduct a major review of the UK mortgage market. After that, he worked as chief economist at Morgan Stanley before taking up his position on the Monetary Policy Committee. Our other speaker is Manuel Albers. For a different disciplinary perspective, Manuel is a geographer and currently associate professor in human geography at the University of Leuven. Manuel has written widely on the interaction between real estate finance, real estate and finance. He's author of Place, Exclusion and Mortgage Markets, and editor of Subprime Cities. So I'm very much looking forward to the discussion that will follow. The format we're going to use is a bit different from usual as well. David is going to start by making a proposition as to how he sees these issues. Manuel will respond, and David will have another chance to respond briefly, and we'll then reverse the order that Manuel will make his proposition and David will respond to it. So, without further ado, please welcome David Miles.
Thank you very much, Mark. What I want to do is make a few very, very simple points, almost simplistic points, and to do it in perhaps a slightly more strident way than I normally would in order to generate a bit of a debate. I mean, it was suggested to me that a good idea was to generate some controversy in this session, and I suspect that won't be that difficult. Manuel, I read in the sort of little bio in the material that you've been handed out, one of the things he's written about is Anglophone hegemony in academia. And I'm wary that I stand here with two affiliations, one the Bank of England and the other Imperial College London. And there's not much more Anglophone than that. My only hope of escaping his wrath is that I'm actually Welsh. But there you go. But with an English accent. So I want to, as I say, make a few very simplistic points, mainly really about variations in house prices over time, the ratio of house prices to incomes, and the evolution of the stock of mortgage lending relative to the size of economies. And it seems to me that there is something of a tendency, certainly in the media, but beyond the media as well, sometimes in academic circles, to treat periods when house prices rise fast, and maybe significantly faster than incomes, and periods when the stock of mortgage debt rises faster than incomes as well. So there are increasing trends in the stock of debt to the size of the economy, or stock of debt relative to household income, and also increases in prices well in excess of incomes, to treat these as generally bubbles, nearly always unsustainable, things that reflect lax lending in the mortgage sector, and things that inevitably will end in tears. And whilst I think that that is sometimes true, I think as a generalization it is in many ways pretty misleading. And that there are plenty of reasons to think that in some countries we may well see a rising tendency of house prices relative to average incomes, and a rising trend in the stock of mortgage debt to incomes or GDP, and that this may not be unsustainable and a sign of problems, but is nonetheless a reflection of what you might call underlying fundamental factors, not necessarily speculative bubbles at all, and not necessarily driven by surges of lax lending from the financial sector. What might be some of those fundamental long-term drivers of house prices? Well, one, I think, is what you might call the underlying real interest rate that clears the global financial market. That's a long-winded way of describing something which is measured in a rather simple way on this graph. This is a picture of the average interest rate on inflation-proof, safe, therefore, about as safe as you can get anyway, inflation-proof government debt issued by the G7 countries, the average of it over the last 30-odd years. In the very early period, it relies rather heavily on UK index-linked debt. The UK is one of the first countries, as people will know, to issue index-linked debt. Lots of other countries issue them more recently. So this is just an average of those numbers, and it's a 10-year yield, a relatively long-term real interest rate. And you can see the sort of fairly dramatic downward trend in this. I mean, basically, in the 1980s, the average of this measure of what you might call a safe real long-term interest rate is 4 to 5%. In the 1990s, it's more like 3 to 4. In the early 2000s, it's sort of 2 to 3. In the mid-2000s, it's about 2. And in the last few years, it's been somewhere between 0 and a half. So it's fallen very, very dramatically over a 30-odd year period. Actually, in the UK, for what it's worth, I don't want to focus too much on the UK, but for the UK, this is just the UK index-linked bond yield, the real interest rate on inflation-proof debt issued by the UK government. That downward trend has been even more marked, probably. But it's kind of a fairly similar picture across the world. Now, it seems to me that if that's a reflection of what you might call the safe global real interest rate, or perhaps the real interest rate in the developed economies, you would anticipate that if there had been such a dramatic decline in that long-term real interest rate, that an asset like housing, which is clearly a long-term asset and whose value you would expect to be related to the real rate of return on safe assets. Of course, there'll be a risk premium on housing over and above a safe real rate, but the real rate element, if that indeed has fallen as much as that chart suggests, you might anticipate that house prices, real house prices, particularly if this was an unanticipated big decline, as I think it was, house prices in real terms might, other things equal, have been driven up fairly substantially. But not equally across different countries. Part of the reason for that is that there are clearly huge differences in both the level of population density and the trajectory of population density, which I think is one factor why, even though there may be a common global force in the real interest rate, how it plays out in different countries in terms of changes in house prices is likely to be very different. Of course, the levels of population relative to the size of countries differs enormously across countries, but I think it's the trends in these things and how they have differed recently and how they may differ in the future that I might draw your attention to. The UK is set to overtake Japan in terms of being the most densely populated of at least these 7 or 8 relatively large economies in the world. I think another factor which helps one map from a common global force, which is that declining safe real interest rate, to rather different implications for different countries, is the obvious differences in the elasticity of supply of new housing, which I would count as another long-term fundamental driver of house values. These are estimates made by the OECD a few years ago of long-run elasticity of housing supply. You can see that there are some pretty big differences across countries, but that many countries, according to these estimates anyway, have an elasticity of supply somewhere short of around about 1/2. I think one of the reasons for focusing on that is that one way to think about a long-run driver of real house prices is to compare the magnitudes of 3 different numbers. One number is the elasticity of demand for housing with respect to real incomes, a number which I suspect in many countries is in excess of 1. In other words, if real incomes are growing by 1%, the demand for housing space, housing units, may well rise by more than 1 if that elasticity, that income elasticity of demand is in excess of 1. I've seen estimates for the UK, for what it's worth, to put that number rather closer to 2 than to 1. That's first number. Second number, that one, the elasticity of housing supply, a number which apparently may be significantly less than 1/2. Third number, the elasticity of demand with respect to what you might call the real cost of housing or the user cost of housing. A number which might be of the order of 1 or so. I'm sure there are lots of estimates that differ significantly from 1, but if you use as a ballpark the number 1, you would then might want to contemplate the following ratio. The ratio of the income elasticity of demand for housing to the sum of the price elasticity and the supply elasticity. And it is quite conceivable that in some countries that number is in excess of 1. The UK may well be 1. If the income elasticity of demand in the UK was of the order of close to 2, and the supply elasticity is under 1/2, and the price elasticity is, say, about 1, then that ratio, income elasticity to the sum of the other 2, would be about 1.3 or thereabouts. Why bother with this number? Because as a rather simplistic model, that would tell you that what will have to happen to the ratio of prices to income over time as income grows. In other words, if that ratio is over 1, the equilibrium house price to income ratio would tend to be rising over time. In other countries, it may well be falling. And I really want to conclude my comments by looking at a sort of rough estimate of what indeed has happened to house price to income ratios across countries. Once again, I rely on OECD estimates across countries. And I guess the thing that stands, so this is an index that was 100 in 1980, and it's an index of house prices relative to incomes. And those lines don't look particularly constant. I don't think that's surprising if you have differences in supply elasticities, in income elasticities of demand, and in the sensitivity of demand to price. And it is perfectly conceivable that for some countries, you would expect that house price to income ratio on average to be rising over time. And if that is the case, it would seem to me quite natural also for the stock of mortgage debt relative to GDP or income to also be rising. And I say that simply as a counter to the view I described briefly at the outset, which was that when house prices rise relative to incomes over time and the stock of mortgage debt rises relative to incomes over time, that's something that's unsustainable and is almost inevitably going to end in tears. And I think that is rather simplistic a view. I would not want to deny for 1 minute that if there is a very sudden and very dramatic change in lending standards by banks, building societies, other lenders, that is unlikely to end well, and the US subprime disaster is a pretty good example of that. But as I say, rising prices relative to incomes over time and a rising stock of mortgage debt to incomes doesn't seem to me something that is necessarily unsustainable and will end in tears. So having made my very simplistic points, let me give way to my colleague. Yes, you do.
Thank you. Might be a little noisy for a second as I put it on. Can you hear me clearly? Okay. Let's see. Thanks very much for the organizers for having me here and also to talk here while Len Seabrook was supposed to be talking. But I think, although Len and I would probably say very different things, I think a lot of the things we would say would also be more or less in the same direction. I've also had a chapter in a book he has edited in the past, so there is a bit of exchange of ideas earlier on. As I was in the plane towards Edinburgh, I was reading an article from 1980. It wasn't about housing. It was an article about intellectual styles of debating and of how you come up with theories, how you do empirics. And not all of it might be true anymore, but there was a difference between French-speaking countries, English-speaking countries, German-speaking countries, and Japanese-speaking countries. And the main difference between the English and the other three, but especially between the English and the German and the French-speaking countries, was that in the English-speaking culture, or the intellectual culture at least, it was very common to invite two people who would do very opposite things and have them talk to each other, even though you might know that in the end they're not going to agree on everything. And they said in the French-speaking and also in the German-speaking countries, it was a little more complicated than Japanese. It is much more common to find someone who pretends that they have very different views, but in the end they agree on most things. So I think, although some of these things might have changed also with the internationalization through conferences of this, there might still be a little bit to this. So on that note, let me go to first a short review of David Miles' argument. Of course, not a full review, but some of the main points he's been trying to make, and then my response to how I see this. He says lax lending is often seen to rise to house price increases, and house price increases are often defined as bubbles. He said both of them are simplistic. I think we can agree. I mean, it's never that easy that the one thing is necessarily the other thing. House price increases can be all kinds of things. Indeed, they don't have to be bubbles. And it's always very difficult to say when something is a bubble unless it explodes and you're like, oh, that was a bubble. As long as it doesn't explode, a lot of people always say there is no bubble. And there's even people when it explodes that say there are no bubbles because there can be no bubbles. That's not what David is saying, but there are people who say that too. Of course, lax lending also doesn't have to lead to house price increases, but it's very likely that it will. Of course, it doesn't mean that all house price increases are caused by lax lending. A causes B doesn't mean A is the only thing that causes B. The other point he makes, quite briefly, is that lenders price mortgages according to interest rates. So in the end, there's only limited freedom in what they do. They compete, and the interest rates are not necessarily set by them. They're predefined, for instance, by national banks, which is also where he comes in as his second role. But that presents us with a paradox, because he also made the argument that in the end, the central banks couldn't have done that much to change house price increases. So on the one hand, the interest rates are caused by what the central banks do, the national banks do, but then the national banks couldn't influence the prices that much because they have only limited power. I think that's not necessarily true, but I think it is a bit of a paradox. If everything is set by the interest rate, then actually the national banks would have a lot of power. But I think it's a little different. It's not that everything is set by the interest rate. And I think in the old world of housing finance, there was a story that made a lot of sense. And I'm not saying it doesn't make any sense anymore, but I think something else has started to happen in the last few decades. And it started to happen earlier in some countries, later in other countries. And that is very much to do with the supply of housing finance, which is not just set at the national level, but it's set partly at the international level. Oh, the wrong button. There we go. So one of the things that has happened over the past few decades is that there's a wall of money. And this wall of money is global. And it's not simply that there's lax lending and mortgage lenders are just giving out money and therefore prices go up. No, there is a massive flow of money that is seeking investment in the world. It's seeking a place where the investment can go. And it can flow into housing. And these are all numbers of the size of institutional investors markets in the world GDP in 2009 in trillions of dollars. And on the bottom, for those who can't see it, it goes, for the institutional investors, it goes up to like $65, $66 trillion. So this is all money that's seeking a place where to invest. There's lots of talk about in the crisis, oh, all this money disappeared, and that's also a media image that's presented to us. But the money doesn't disappear so much. Some of it was only money on paper, and most of it doesn't disappear. And actually, a lot of money was there waiting still to be invested. So political economists talk sometimes about it as a wall of money, or about excess liquidity is also a term that's being used. And that money can go into housing, but it doesn't necessarily do that. What causes high mortgage debt? Well, many different things, but I'm going to kind of zoom into one that's often not given that much attention to. The IMF had made an indication of mortgage, what they call the mortgage market index, which is basically an index about how the regulation is organized for mortgage markets in a certain country. How easy it is for global capital to flow into mortgage market, how easy it is to expand, and that's what we see on the vertical axis. So the countries to the bottom, Italy and France, are countries where it's not so easy to expand mortgage lending. It's not so easy for global money to come in. You can find some securitization of mortgages, but it's not necessarily that much. And all the way to the top, you find countries that have made it very easy for money to flow into mortgages. Through bonds, through securitization, through the way that there can be caps or no caps in this case, on loan to income, loan to value ratios. And it's not my index, the index by the IMF. And can be questions in some accounts. And I think some countries actually should be in a slightly different position. But by and large, it gives a picture of how deregulated or how free it is for money to flow into mortgage markets and therefore into housing markets in different countries. Then on the horizontal axis, we see mortgage debt to GDP. And what it suggests is that there's a very clear correlation, 0.8. And that correlation basically shows that countries where it's easier for money to flow into the housing market are the countries where mortgage debt goes up compared to GDP. Actually, of course, this picture doesn't show the trend. It shows a static state in one particular point in time. But you can actually follow countries through time as well. So you see Spain, for instance, has been moving up. Spain used to be in the corner with Italy and France. Spain has now moved to the middle. Ireland has also somewhat moved to the middle, also used to be more in the bottom left corner. And then, of course, there's some countries that score a little higher on the one than on the other one. The US is considered more open to the IMF than Denmark and the Netherlands, who are all the way to the right, but who have higher mortgage debt to GDP ratios. And actually, there's other calculations that put them even much higher than this. So a lot of these data, there's small questions about it, but the general picture shows that actually there's all this money flowing into housing, but much more so in some places than in others. And the places that either moved very fast from the bottom left corner to the middle, Spain, Ireland, or countries that are on the top right corner, US, Netherlands, Denmark, and to a lesser extent Australia and the UK, are countries where you have seen a lot of money going into housing and also, therefore, mortgage debt to GDP going up. So my argument is that it's all nice to talk about the elasticity or the inelasticity of housing demand and housing supply, but in the end, it's the demand and supply of housing finance that's crucial, and especially the supply and this wall of money going in. This wall of money seeking investment. And housing has the ability to absorb the global pool of excess liquidity, this wall of money. But this is a very uneven process. And you can see that very well in the picture. And the absorptive capacity depends on institutional factors, including all kinds of parts of market regulation. Some of them that in legal terms are considered regulation, other ones that are not. But in sociological terms, all kinds of regulation done by different arms of the state, regulators, and so on. And for each country, you could discuss in depth how this has actually happened, what the institutional factors were, how they have changed, how they made it possible for global excess liquidity to flow into housing. But we won't do that now because I only have a few minutes left. So what we see is that there's also a debt overhang in some countries. And those are the countries that after 2007, 2008 typically had price declines. And they weren't necessarily the countries that were in the biggest economic crisis. Some countries had big housing crises without necessarily having a huge economic crisis. They didn't necessarily go together. Of course, there was some feedback effects. If the housing doesn't do well, some of the other parts of the economy also don't do well. But it might be interesting also to do a correlation between what happened to economic growth and what happened to housing prices. And I bet the correlation is not as strong as the one here. But what we see, a lot of these countries have still not been catching up with housing prices. And it's also because for a while it was actually that excess liquidity, that wall of money, didn't know if it wanted to go into housing again. But now it is going into housing again. And you could even add all kinds of rapidly developing countries to this picture and then see where actually the money is flowing now. And you could start to track countries like Brazil, Turkey, Russia, and it would be quite interesting to follow those over the next few years and see if, like Spain and Ireland from years ago, they're moving away from one corner into another corner and opening up to flows of global capital in these markets. One of the results, of course, is this. If the mortgage debt to GDP goes up, yes, it might be partly because interest rates are low, but interest rates were low in many of those countries, and the mortgage debt to GDP went up much more in some countries than in others. These tend to be countries where people take out big mortgages, and you don't necessarily make down payments. So people have large loan-to-income ratios. Their mortgage is very high compared to their income, and their mortgage also tends to be very high compared to the value of their home. Which means that even in a situation if the housing prices stay up, you're just very much at risk. Because if you get unemployed, it's much worse than if you have a smaller mortgage loan covering a much smaller part of your housing prices. And the effect is, of course, that the housing prices go up. When I explain it to my students, they always say, like, well, how can all the prices go up and how does it happen? They'll tell one simplistic story, and then in the next hour I tell all the little things about it that are not so simplistic. But one of them is, imagine that all of you on one day could get a mortgage. And you can all get 100,000 euros. And then a few months later, your income and effort is still the same, and all of a sudden you can get 150,000 euros. And you're going to be like, wow, I can get 150,000 euros. I can buy a much more expensive house now. But what happens if this happens to the population at large? People are going to bid on the same houses, especially in a situation where there's a lack of housing. So in the end, that can drive up prices. And of course, there's all kinds of other factors that interact. And I said that this is a simplistic story, but it is partly of what has happened in a lot of countries. It is not just individuals who, because of income growth, can get bigger mortgage loan. It actually happens on a much larger scale. And I'll get back to that in the second part of this session.
Your main presentation in a minute.
Yeah.
Do you want to respond quickly to
Yeah.
that?
Yeah, let me just take a couple of minutes to respond to some of the things that Manuel says, many of which I agree with. But maybe there's a kind of difference of emphasis or interpretation. Manuel talked about a wall of money, and that sort of sounds vaguely sinister. It's like, you know, there's a big wave coming toward us, which is going to do us some damage. And I don't disagree with the wall of money terminology in some senses, although I'm not sure I would describe it as sinister. I mean, the big wall of money, it seems to me, in the last 10, 15 years, has been, to some extent, a reflection of the integration of an enormous economy into the global economy, which is China. And China has run an absolutely enormous current account surplus, and its population has an extremely high propensity to save. That's part of the reason why it has had such an enormous current account surplus. They want to acquire assets. They want to save to a large extent on assets which are not issued by Chinese entities. That may have something to do with perceptions of risk and the development of financial markets in that country. That money has flowed out to a very large extent into the global bond market. It seems to me the major reason why the chart I showed you right at the outset, which was a measure of the global real interest rate on relatively safe assets, that is inflation-proof bonds issued by governments, just falls and falls and falls and falls. Now and an implication of that is that the real cost of borrowing through the banking systems for many households in many countries in the West has actually declined quite significantly. That's part of the equilibrating process, if you want to give it a sort of pompous phrase, of the global economy to a very big shock, which is, as I say, the integration of an enormous economy, which rather simplistically, to some extent, had been cut off from the rest of the world, and then is integrated with it in a relatively short period of time. And I sort of, as I said, that's why I think that the phrase wall of money, which makes it sound sinister and bad, I'm not sure I would describe it as in quite those terms. Manuel, you quite rightly said that in some sense there was a tension, almost a contradiction in something I said. I said that central banks set one interest rate, that is the short-term nominal interest rate. That's what the ECB sets, what the Bank of England sets, what the Fed sets. So it's a very short-term interest rate, and it is a nominal interest rate. I think there are two senses in which that great power of central banks to set that interest rate actually is much less powerful as a way of trying to hold back inexorable forces sometimes that drive up house prices. Firstly, because it is short-term and nominal. And if you think about the value of houses, you might think that one of the major drivers should be a long-term real interest rate. And that long-term real interest rate, I think, is set in the global bond market, and central banks who set a short-term nominal interest rate cannot control a long-term real interest rate. That's one reason why I think central banks' ability to try and control what's happening in the housing market is somewhat limited. There's another reason, which is that governments in most countries have given central banks a particular task, which is to try and hit a target for consumer price inflation. That's true in the US, it's true in the UK, it's true for the Eurozone. And there is some, but really rather small, impact of house price changes on measures of consumer prices. In the UK, it's pretty negligible, actually. So at the moment in the UK, we have, on the national level, house prices rising at about 10%. Consumer price inflation is 1.5%. And there's very little linkage between those two things. So if you give central banks as their main objective to try and control an index of consumer prices, it's very hard at the same time to tell them, by the way, if you can also try and control house prices, which don't really enter into a consumer price index very much, then you're just giving them contradictory things. You have to give them sort of clarity on what they're trying to do. A third very brief observation to the charts that show sort of an index of mortgage liberalisation against the stock of mortgage debt. And it's striking how close that correlation is. Perhaps it's not that surprising that if you have a relatively liberal mortgage market, perhaps the stock of mortgage debt is going to be greater. I guess the question I would put to Manuel is, well, so where do you want to be in this chart? Do you want to be in a world in which there are all kinds of limitations and restrictions and rationing in the mortgage market, so that it's really rather difficult for people to borrow to buy houses? That will give you a lower stock of mortgage debt to GDP, and very likely it will give you a lower level of house prices than you otherwise would have had. The market will clear in some ways, but it'll be as a result of restrictions and rationing, some of which may be sensible, some of which may be just a means of keeping the stock of mortgage debt low and house prices low? Or do you want to be further to the right, where it's much easier for people to access mortgage debt, with the almost inevitable implication that the way the housing market will then clear is through prices being higher? And it's not clear to me, in a sense, where you want to be on that picture. I'd be interested in your thoughts on that.
Thank you again, David. Let me start with the last question. Because, of course, it's not easy to say, like, where in that picture do you want to be? But if I would have to choose, let's see. I would want to be here. I would want to be in Germany. I don't think the German housing market is anywhere near perfect, but I think the way the housing market is not very heavily financialized, that people still make down payments when they buy a home, where house prices, comparatively speaking, are relatively low. Things went wrong in Germany in the crisis, and there have been cities that almost went bankrupt, and there's been banks that got out of business. But the housing market in Germany, the rental prices have gone up. That's one thing that's happened. We've heard also someone speak about that yesterday. But if we look at the home ownership market, actually this is a pretty good place to be. Now, next to my second part of my talk, and some of the things actually have already been said by David or by myself in other ways. So maybe the second round of debate is going to be a little bit shorter than the first half. The Great Moderation, a term I think that most economists will know, but probably most people outside there might not be familiar with. In the early and mid-1980s, most Western countries recovered from the many blows the 1970s had dealt and slowly entered a new era of moderate but steady growth with smaller GDP and interest rate fluctuations than in previous decades. So these smaller GDP and interest rate fluctuations, and David referred to it in some way by lowering looking at lower interest rates and that stay relatively low. That is what's referred to as the Great Moderation, a macroeconomic cycle. And it is considered that this has started in the US in 1984. It's very well documented for the US. People have written a whole series of papers when it started, when it didn't start. And in other countries, it has started somewhat earlier, somewhat later. And there are a couple of papers in France, for instance, a few in the UK, but not that many in most other countries. Although I might have missed some of the literature as well. And a great deal, now I go to the next topic, but soon I will connect them. A great deal of financial innovation that people often talked about before the financial crisis is actually built on leverage. And it could be argued that for some years the combination of a counter-cyclical monetary policy and financial innovation / leverage kept growth numbers up and business cycle fluctuations down. All was good. But leverage also has the potential to magnify developments, multiplying both growth and decline. And this is exactly what happened in the run-up of the financial crisis, when monetary policy became pro-cyclical on the upswing, not everywhere, of course. Again, the picture is much clearer for the US than elsewhere. As well as in the crisis itself, when losses were magnified as a result of excessive leverage. The Great Moderation had come to an end. And I'm not saying necessarily that monetary policy could have done much better, but what I am trying to indicate that the Great Moderation, and that sounded so nice, steady growth for a number of years, small fluctuations. Actually, a lot of it was built on financial innovation. And when that financial innovation came to an end, also the Great Moderation, in a sense, came to an end. Once we start looking at mortgage markets again, at housing and finance, it's been very important that in many countries there's been a lot of institutional changes in mortgage markets. And even though financial innovation may not have caused the Great Moderation, it is still important in the mortgage market where new suppliers of credit entered the market and non-traditional lenders increased their market share. After 1985, savings banks, specialized mortgage bank, credit unions, building societies, cajas, etc., generally lost share and were acquired by or changed into general or commercial banks. And this story has been very well documented in different countries. Different countries had different systems, but in many of those countries, the system of housing finance was quite separate from the rest of banking. And the ways have changed are different in different countries. In some countries, there's the demutualization, like you see here, and building societies actually are not building societies anymore. In other countries, the general bank started to take over, and now it's like, well, the general banks, were they? And they're always giving the mortgage loans? Well, in many cases, they were not. And then there's other countries where non-bank lenders come in. And that happens especially in the US, but not only again in the US, where securitization, the reselling of mortgages in the secondary markets, made it possible for new lenders to step in. So all these changes have been very important, not just in the institutional landscape as such, but they have made it different how money flows into housing, because a savings and loan institution or a building society or a bouwsparkasse is quite a different thing than a general bank, and it is quite a different thing than a non-bank lender. And it also depends very much how much these type of lenders are depending on securitization, on bonds, or on savings to actually finance mortgages. And those different systems mean that some of them are going up much more up and down than other ones. So there's all kinds of factors there that actually change how mortgages are being given. I'm not going to say too much about the support of home ownership. There's a lot of that. There's a lot of the literature where it says like, in a lot of countries, home ownership is actually supported more than rental markets. Then there's some evidence that says actually it is more balanced. But what I think is very important that a lot of the support of home ownership may have started out to help out homeowners. But in several of those countries, and those were again mostly the countries that were on the top right corner in the earlier graph, are countries where actually support for home ownership became much more the support of financial markets and of mortgage markets, more specifically speaking. And it's also typically the countries where the financialization of the economy is the greatest. In the US, since the beginning of the Great Moderation in 1984, credit to real estate and finance increased from 81% of GDP to 260% of GDP. Of course, that doesn't necessarily mean that this is crowding out other investments, but there are actually indications this is happening as well, but showing those calculations will take another 30 minutes to make the argument well. But people have made this argument for different countries. Greta Knipner is most connected to this kind of literature. And we see as a result a massive growth of mortgage lending, what we've already talked about before. And I'm going to give one example, and it's been a favorite example over the last so many years. So if you've heard the example before, I apologize. This is an example from the Netherlands based on calculations of the Dutch National Bank. The Dutch National Bank looked at 94 and in 99, 5 years difference. They looked how you could get a mortgage, what kind of mortgage you could get. And they took some vignettes, and the one basic one was the average household. And in the Netherlands, that was a household where one partner had a full income, and the other partner had a part-time job, and then it was calculated how much they each would make. So it's not the average for the population, it is the average household, which is a different thing. And what it shows in 5 years' time, and then controlling for income growth, controlling for interest, for all kinds of things, it turns out that households 5 years later can get an 86% bigger loan. So the example I gave before, if you get 100,000 now, in this case 5 years later, you could get 186,000 as a loan. Your income hasn't changed, or it's controlled for that at least. All the other major things haven't changed that much, but just in these 5 years' time, although things stay the same, you can get a much bigger loan. What do you think was the period where the housing prices in the Netherlands went up the most? 94 to 99. There's often been a lot of talk about it in the 2000s when housing prices in the Netherlands did go up as well, but actually they went up much less. This is the period where things really got out of hand. Loan-to-value ratios, so how big is your loan compared to the value of your house, the price of your house, they went up a lot. Loan-to-income ratios went up a lot. And one important thing, people were not making down payments anymore. And people were told to be crazy if they would actually make down payments. Like, why do you want to make a down payment? Because one of the things was, there was already a system in place where your interest rate payments you could deduct from your income tax. That system was already in place. That system didn't change. What changed significantly in those years, but it started a little earlier and it kept on going after 99 as well, is that mortgages were designed to exploit that part of the fiscal system. Not in an illegal way, but looking into how far we can do this. So you got interest-only mortgages. Some mortgages went into stock investments, some went into savings, which you would call an endowment loan, endowment mortgage here in the UK. Yeah. And of course, what you saw as a result, as I said, fast increases in housing prices and also household debt exploding. And although actually the amount of people that were able to buy went up in that period because it became so easy to get a mortgage, what people were spending on a monthly basis, also after taking the tax advantage into account, actually the share people were sharing, the share of their income people were spending went up. So then we get to the last slide. And what I think this is an example of, and this fits in the general picture. In the Netherlands, is not the most average case in this. It is a little bit more extreme, but we have seen this picture in other countries. And again, the countries in the top corner, in the top right corner, were quite extreme in this, but also countries that moved from the bottom left to the middle, like Ireland and Spain, also saw similar processes. The great moderation turned into a great excess. And again, that might not be a very neutral term like the wall of money, but I chose them because of that. Mark already in his introduction said something about, he didn't use the term privatized the house price Keynesianism, but already the idea that to fuel the economy, sometimes people were giving, the idea was on a higher level, mortgages were actually able to fuel the economy, and they were compensating labor, they were compensating workers for limited or no income growth for a long time. But we see that the wealth effects of home ownership are very unevenly spread. My argument is not that people don't have benefits from housing anymore because it's all financialized. No, that the benefits that were always unevenly spread have become more unevenly spread. And that's partly because there's now many new homeowners who have a lower income, which also makes it very hard in many countries to interpret the development of house prices. Because in countries like the UK or the Netherlands, the home ownership got expanded so fast that who was a homeowner in 1980 was a relatively small group, and who was a homeowner in 2010 was a very large group, and mostly at the bottom home ownership grew. So normally speaking, you would say then housing prices should go down if there's more lower income people. And of course, a lot of these advantages didn't end up with a lot of those people. For some years they did because the housing prices were going up as well, but when housing prices went down, they tended to be the younger households, people who bought a house relatively recently, who had high mortgage debt, who were very sensitive to shocks in their income, how it would affect their mortgages. And the advantages of home ownership for those people, again, not the entire population, were not that significant anymore. Also, saving in brick for retirement, the whole idea of asset-based welfare, exploded in these people's faces. And I know people also close who actually had this kind of experience, and not all of them were necessarily fitting in the boxes of who would do this the most. I know older people who thought, I'm going to buy a house 10 years before I retire, and at least then I have a house when I retire. And also, this blew up in their face. So I think what is important that a lot of these features that we think are benefits of home ownership are actually benefits of how we treat home ownership, how it's treated by the state, how it's treated fiscally, how it's treated in all kinds of other ways, where home ownership units are located compared to rental units. The location is an important one as well. And that there's a political project, of course, that has pushed on ownership. We already know that not for a very long time. But I think a large part of that project is actually still hidden behind the guise of trying to push home ownership. And a lot of it was a project to push finance. Thank you very much.
Great, thank you very, very much. We're going to move straight to comments and questions now. So, do we have some? Right at the back.
Good morning. I thought that was a fascinating presentation, and I just had a question for Manuel. I'm just thinking about this wall of money that you're talking about, this global capital, transient global capital, and I'm just wondering about the extent to which you think responsive measures to crisis in national mortgage markets, for example, Ireland, measures that are designed to alleviate distressed borrowers, or measures of that nature that alter the legal rights and the framework for mortgage lending, the relations between lenders and borrowers, could potentially disincentivize flows of capital into our national mortgage market? Or is it a case that there would be, it's a comparative, it's an overall, rather than focusing on residential, because all of the interventions are to alleviate residential mortgages, primary residences?
Of course, it would be very hard for me to say something about Ireland, where I was last year, but I'm not a specialist on. But I think, yes, it is possible that if you take certain measures to limit some excesses or to limit some other things, that there might be less money flowing in. The question would be, is that a good thing or a bad thing? The problem is also, once you're in the bottom right and the top right corner, it's very hard to go back. Once you're still in the bottom left corner, you can stay there, and you know there are some limitations to that, as David said. I'm not denying that. But once you're going up further, you can't really go back anymore. Because then it's going to blow in your face, because also the electorate is going to say, we want our house prices to stay up. You've promised us that this is good for retirement and all kinds of things. You said it was good, the houses were, et cetera, et cetera. So it is going to be very difficult to do it. But I think, yeah, in a limited way, you would have to do it, even if it would mean less money is flowing in. The question is also, like, is all of that money flowing in really beneficial for those households and for your economy? Probably not. Is it bad that housing prices go down? Yeah, for a lot of people it is. But actually, for new home buyers, it's quite nice that housing prices go down. And also, if housing prices go down, most people, when they move to a bigger unit, which is typically more expensive. So as the housing prices go down everywhere, but of course they never go down exactly the same everywhere, you might also be able to buy a cheaper home. But again, that doesn't help the people who are actually in foreclosure, who are in default at that moment. So yeah, you would have to have all kinds of measures. And if that means some limits, yeah, that's...
So am I taking from your response there that what you're saying really is that it's not necessarily a bad thing if there is some sort of a decrease in the flow of funds coming in, because it's going to have less of an inflationary impact on the market generally?
Yes.
Yeah. Yes. No, what I'm just wondering is, about, we'll say lending is quite static in Ireland at the moment, and I'm just taking it as I suppose a case because the significant state intervention in the legal relationship there, and what's concerning me, or what I'm querying, is whether or not it's actually going to have a very detrimental impact, as in there won't be the capacity to lend because banks don't have recourse to funding. Now, I know there are various funding strategies and all of that, but I'm just wondering, in terms of what you're talking about there, whether or not the issue is rather going to be that if what our soft law measures harden, that what you will have is, on your IMF data there, and the kind of perceived attractiveness of the market as assessed with reference to legal factors and legal certainty of rights, whether or not you're actually just going to have it kind of blackballed, for want of another word, in terms of attractiveness. Are you going to have it as a non-desirable location for investment from that point of view?
That is a risk, yeah. I can't deny that. Yeah.
Okay, good. Any more questions, comments? Peter Bullhauer.
Thank you, Manuel. Very nice presentation. If you look at this graph, you would expect that there would be big differences between house price developments in different European countries. Actually, if you make a comparison and you don't take the Netherlands into account the last 3 years, because that's another story, of course. What always strikes me is that there's so much correspondency actually between the general developments, and sometimes in the Netherlands we had some price explosion indeed in the last years of the 90s, but in the 20s it was much slower. So actually, so the house price development and this graph is not corresponding quite well.
But it's not simply house price development. It wouldn't mean that all the prices, all the ones on the right. It's how also the countries move. And when countries tend to move further to the top right corner, that's when the housing prices tend to go up a much. So you see Spain and Ireland are in the middle here. So my argument is not Spain and Ireland have average housing prices. No, the housing prices went up there a lot because they came from the bottom left. So that might be the same trend as the Netherlands, who might have been a little bit more in the middle first and moved a little bit more to the top right corner. But countries that stay in the bottom left tend to have less house price increases. And of course, it's not a necessity. But also, if you look at the absolute levels of the housing prices compared to income, Germany, it is also cheaper to still buy a house in Germany than in the Netherlands.
Yeah, well, I think partly right, but some of course, Germany is quite an example, and the Netherlands is also the last couple of years. But even Spain and Ireland, if you look for a period of 50 or 20 years, there's not so much differences between the other European countries.
I think if you look at many graphs, there's huge differences, but it also depends which year you start. That's always the case.
It depends on the period, of course. Yeah. But if you take a longer period, the differences are not so big, I think.
Yeah, but the changes in Ireland and Spain didn't happen over a very long period. They happened in less than 10 years. So, and in those 10 years, the house price increases in those countries were way higher than in any other country. So, and that is exactly when the countries move. And that is part of the story. When those countries start to move from one position in this diagram into another position, that tends to be when housing prices go up a much.
Yeah, I agree. There's also the Netherlands, the end of the 90s, but after that you get a reaction again, and then it stabilized more or less. The increase in the Netherlands was much lower in the last 8 years than it was before.
But what I was saying also in my talk, like between 94 and 99 was the big differences in how mortgages were given in the Netherlands. The Netherlands moved further to that corner. That was the period when the prices went up a lot. Less happened after 2000, 2001, and the prices also didn't go up that much anymore. So that's exactly fitting my story.
Okay, thank you.
Questions?
Any more questions?
Duncan Bower, University of Westminster. Thank you for both presentations, which, but I mean, both of you very much focused on the role of control of mortgage supply in the housing market and comparing different countries' positions. I'm interested in if either of the presenters want to comment on the role of taxation, either in terms of incentivization or property and wealth taxation or inheritance taxation in stabilizing the housing market and actually leading to the more effective use of the housing stock. Thank you.
Well, things almost falling.
Maybe I'll just speak loudly. It's easier than doing this. Just a couple of observations on taxation. Actually, one of them comes back to the Netherlands, where as an outsider, and again, this is going to be a very simplistic statement, it seems to me that part of the problem in the Netherlands was not so much what you might call financialization, which again you made sound terribly sinister. It's just they had a tax they had a tax system that made it perfectly rational to maximize the amount of debt and never repay it. You know, if that's the tax system, well, it's going to have implications. But on the more general point about using the tax system to try and moderate outcomes perhaps in the housing market, you can certainly mess up housing markets with silly tax systems. I mean, I think in the UK we do a pretty good job. Stamp duty, which is one of the main taxes on housing, is a pretty daft tax. People probably understand stamp duty very well. I mean, it's a kind of slab system. You pay a certain percentage on the purchase price, and there are a relatively small number of different rates, and they suddenly jump. But if you get above the top rate, it doesn't matter how much the house then is worth. I mean, it's just a crazy, it's a crazy system. I think there's a lot to be said for having a relatively predictable and stable tax system rather than trying to use it as a regulator that you kind of switch on and off. And probably like many people in the room, perhaps many economists, see a sensible tax actually is to have a tax on the value of housing. I mean, that's seems to me a sensible tax. Just a straight proportional tax on the value of property, and that's a million miles from where the tax system is in lots of countries. It's completely the other end of the spectrum from where we are in the UK.
One last question, perhaps. One more? Okay. Well, it seems we've reached complete consensus. So it remains to me to thank Manuel and David for their incisive presentations and for their collaboration with our desire to get a bit of interaction and discussion going. And thank you all for coming to this session.